We're now into December, and today we're seeing weakness across most of the S&P 500, but consumer staples continue to get slammed, and a big part of this comes down to the economy and consumer sentiment, which has continued to deteriorate throughout 2025. Now, it hit the second lowest reading on record back in April, and the latest November data, well, it still shows sentiment, in fact, sitting near the lowest levels we're talking since post-liberation period. And while we look at the S&P 500 from a year-to-date perspective, it has held up surprisingly well, but like we have just pointed out, consumer staple stocks have been hit hard. Many names, in fact, we are talking down double digits. But when we talk about this, it shouldn't really come as a major surprise. The writing has been pretty much on the wall all year. We've got Chipotle warning over the summer that consumers are getting gloomy and cutting back on burritos. We heard from Walmart's CEO back in March that shoppers are spending less across nearly every single category. And Procter & Gamble, well, in fact, they pointed out slowing demand as stressed consumers trade down from some of the big brands. And ultimately, people are becoming a lot more thrifty. They're hunting for discounts, and that's rarely a good sign for the economy. Even Pepsi, well, they've tried to counter all of this. What they've done through shrinkflation, lowered their price points, while in fact quietly making their products smaller. We also have Gen Z, they're tightening their budgets too, and today Procter & Gamble CEO, well, ultimately he did confirm what we've been seeing all year: consumers are struggling. So in today's video, we're looking at 7 consumer staple stocks that have been crushed, and we'll figure out whether this is the perfect time to buy the dip or a group of stocks that you should completely avoid. And it's quite interesting to see at the beginning of the year, JP Morgan had an article on when is a good time to invest in consumer staples. Back then, they weren't doing too bad. Most of these companies are in fact down quite severely. We're going to run through quite a lot of these. And for those that don't know, well, consumer staples, they're physical goods that use everyday food, cleaning supplies. We're talking some well-known companies: PepsiCo, Procter & Gamble, Kimberly-Clark. We've touched upon some of these just now. And one of the reasons people do typically invest in some of these names, yes, we do see them move with the market up, down. They're not as volatile as some other investment categories, but they also don't return as much during periods of steady growth. So something just to bear in mind. And this is what it ultimately comes down to. They say typically you would invest in a sector like consumer staples if you think growth is slowing pretty materially, if you think we are going into recession. Something to think about: if you agree with this statement, you do believe we're going to see a slowdown in growth, perhaps a recession is on the cards, and you can see ultimately there is a reason why they call this sector in particular a defensive one. And we even have Morningstar from just a couple of weeks ago talking about the best consumer defensive stocks to buy. They run through 12, which you can see on screen. Some of these we are in fact going to cover in the episode today. But the main takeaway here is we can see massive disparity from the overall market and consumer staples as a whole. So let's kick off with Procter & Gamble, Dividend King. We have briefly touched upon some of the issues this company, along with the economy, is facing. Now, they're down 20% in the last year, year to date down 14%, and actually over the last 10 years, not the greatest. As we touched upon, this sector in particular doesn't see a lot of growth, is up only 86%, is also pretty much now trading around 52-week lows, where we get a double hold from both Seeking Alpha as well as Quant. Wall Street do give it a buy, 4 out of 5, and we now see it at a forward P of 20. This is the lowest it's been valued in at least the last 5 years. This is the data we have available now. On a 5-year average, it sits around 24, peaked in fact as high we can see here around 27 at the beginning of 2022. And whilst we don't look at this in isolation, we would say potentially severely undervalued. And one thing that really gives away the undervaluation, the yield is near the 3% point. This is the highest it's ever been in the last 5 years at least. In fact, the second highest was around 2.85 in the middle of 2022. Another signal here of severe undervaluation. Now, given the massive disparity between where the yield sits and the 5-year average, we have to mention the dividend safety, 99, the highest score obtainable, very safe. That is great to see. And we'll also touch upon the dividend growth itself. Well, it's up 5%, just in April this year. Nice to note, it's above the minimum we want to see at 4%. That is just to keep up in line with inflation, but that's pretty much what we see over the last 10 years on average. And you're probably familiar with the fact that this company is a dividend king, 50 plus years of consecutive increases. They've also been paying one for 135 without a reduction. And when we look at the blue tunnel, which for newer viewers signals the fair value, the intrinsic price, we're seeing for the first time in the last year below the bottom end another potential undervaluation signal. In fact, during the Liberation Day, where most companies were trading in a severely undervalued level, Procter & Gamble was not. We are now seeing that today. And in fact, zooming out to the last 10 years, firstly, nice to see it is an upwards trend, but extremely rare does this enter below the bottom end. In fact, you'd have to go all the way to mid-2018 to really see a similar scenario. Doesn't mean it's an insta-buy, but very fascinating to see. And then if we talk about the valuation against the sector, they do ask for a premium which sits at 29%. As we can see against their own 5-year average, it is at a 13% discount. And whilst we're not going to cover it moving forwards, as these aren't fast-growing stocks, for those that want to see and for the consistency across the episodes, the price to earnings growth does sit at 4. Now typically we want below 2. That does just really relate to fast growing companies, so this isn't something we're going to incorporate today, but the data is here. We'll just highlight against the sector 47% premium, against their own 5-year average a very small 2% discount. Again, you can see the information here for the other stocks, not something we'll continue to discuss today. And finally, very important to cover each one of these, their growth, because this really does give away the struggles the company is facing. Year on year, it's up only 1%. That is in real terms a decrease because inflation sits at 4%, expected only 2% over the next year. We can see sector also struggling 2 to 3%. They're also growing slower than they have done over the last 5 years, which is also in fact just below inflation. We're covering 7 companies today, so we will try to be fairly brief, but the intrinsic price is the average of the 3 models, where when we do the deeper dives, we do run through every single one, discussing inputs and outputs. Fascinating to note, on a DCF, pretty much the same as when we use all 3 models, and if you do want to see, we've used a growth rate of 8% moving forwards. Baked in today is 6.7%, may make you believe based on this over or undervalued, depending on where you see the growth over the longer term. Now, using all 3, we get a margin of safety that sits around the 10% point. That is what we typically do kick things off with if we believe the company meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. You could argue PG is really struggling with all of those, so you would want more. For example, at 20%, a buy at 127, at 25, 119, and Wall Street themselves, they actually see upside of 18% into next year. Their price target is $170, which as always, you can grab a copy of this model by click on the pinned comment below. So let us know, stock number 1, Procter & Gamble, is it a buy, hold, or complete avoid? Before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Kimberly-Clark, battered down 23% in the last year, down 18% year to date over the last 10 years. Fascinating, if you bought 10 years ago today, didn't reinvest dividends, you'd actually have less. For example, investing $10,000, you'd now sit on around $9,000, and we can see pretty much peaked. We're talking around the COVID era, August 2020, at $158, where it's trading towards the lower end of the 52-week range, and we get fairly rare triple hold right across the board. Now, they're also trading at their lowest forward P in a long time, 13.8, in fact 5-year at 19, so another potential severe undervaluation. Highest mid-2023 at 24. Yield moving towards the 5% point. We actually saw that a few weeks ago, well above the 5-year at 3.6, and a dividend safety score that sits at 70, which is good to see that safe level, and pretty consistent in terms of their dividend increases around the 3 to 4% point, which as we said is around the inflation level. They're also a dividend king, fairly recent with 52 years of increases, 90 years of paying one without a reduction, and we note here it's below the bottom end of the blue tunnel, something we have noted for a few months over the last 12, but again this does highlight potential undervaluation, whilst noting though the blue tunnel has stayed pretty flat, and over the last 10 years those comments can in fact be mirrored. Blue tunnel very minimal in terms of upwards momentum, but we do notice fairly rare to see this in a severely undervalued level, at least stretching the last 10 years. Now C- on the valuation, you're actually getting, unlike what we saw from Stock 1, a double-digit discount to the sector and a 27% discount to their own 5-year average. And growth D-, well, revenue was up 12% year on year, expected to decline 6%, not great to see. Even the sector expected, even below inflation, still an increase of around 2.6%. Their own 5-year average, pretty terrible in all honesty, around the 1 to 2% point. Earnings per share, not looking the greatest, projected 3% growth over the next 3 to 5 years, below both sector and their historical at the 5 to 6 level. And our intrinsic value at $132, well, actually interesting to see the DCF coming a lot lower. We've used 5% moving forwards, baked in is there or thereabouts at 4.6. So if you solely want to look at this model, you could argue fair price. But if we do use the combination of the three at 132, which interestingly is pretty much where Wall Street see this in the next year, you're talking about a 20% MOS. You want 25? Well, a buy at $99, which was pretty much bang on around the 52-week low, and Wall Street anticipate 23% upside, so give us your views on KMB. Now this one probably doesn't fit straight into the typical consumer staple stock, but Zoetis, this one's battered down around 30% in the last year, down 23 year to date. Over the last 10, actually in fact not too dissimilar from the S&P over this performance, but you will notice from the peaks that we can see here, December 2021 at $244, it has been in a downward trend, right now sitting around 52-week lows, with a respectable buy from Wall Street, 4.1 out of 5, with a double hold from the others. And they're also trading at their lowest forward P, 18.8, versus the 5-year average at 31, peaked around the 50 level at the beginning of 2022. Ever since then though, like the share price, valuation has come down, yield sitting at one of the highest, 1.6, near double from the average at 0.88, and good to see a safe score at 74, where they've actually increased the dividend at a double-digit rate. We're expecting as well over the next few days an increase for 2025. Over the last 10 years, 20% year on year, and they've been increasing it on the lower end today at around 11 years consecutively. And on the blue tunnel, we can in fact see over the last year this one continues to trade in that severely undervalued level, disparity quite high between the 2 points, where when we do zoom out to the last 10 years, actually good to see the blue tunnel continuing to increase, although over the last few years we have started to see a bit of a slowdown. Now deep loss on valuation, pretty much trading in line with the sector, huge 40% discount as we highlighted to their 5-year average, and their growth sitting at a D-, we get 3% year on year, projected 5 over the next 12, still though below the sector in the mid-single digit, and also quite some way below their own historical at 8%. Now they're projecting actually 8% in terms of EPS moving forwards, but the sector as well as their own 5-year sits a little higher at 10 to 11. And our intrinsic value at $156 is solely derived from the DCF model. Now actually their 10-year CAGR in terms of the growth year on year on average for the free cash flow is 20%. Baked in today is 7.1, and we have used 10%. Remember, these numbers are subjective. You can always grab a copy, click on the pinned comment below, running your own numbers, Zoetis or any others. But using that 10% rate, what we are finding here is a 20% margin of safety. Well, look, Wall Street actually see this higher at 170 into next year, which means they probably anticipate around an 11% growth rate moving forwards, as 168 not too dissimilar, and that in turn is giving you 26% margin of safety. As we said, Wall Street 170 into next year, 37% upside, but give us your views on Zoetis today. We then move on to PepsiCo, which is down around 10% over the last year. 3.5 years to date, has staged a little bit of a comeback, but over the last 10 years, not great, up 50%. Downward trend around the $200 mark May nearly 3 years ago, and trading today in the midpoint of the 52-week range. We did see it 52-week lows this year, so has started a bit of a recovery. Nonetheless, all three analysts giving this a firm hold, and we can see one of their lowest valuations at 17 forward PE, historical average 23, yield 3.9, above the 5-year at 2.9, so we're seeing the same trend across all of these stocks today. Undervaluation potentially is appearing, and they also have a strong 93 very safe dividend score, where they increased it 5% this year, 7.7 on average over the last 10. They're also a recent dividend king, 52 years of increases, 60 years paying without a reduction, and we also notice over the last year this one has been trading in a severely undervalued signal, where over the last 10 years, very rare, we only pretty much saw this around the beginning of 2024. Whilst the intrinsic price is increasing, share price is moving the other way. This is always where opportunities do in fact lie. Now valuation D-, 13% premium to the sector, 19% discount to their 5-year, and a D+ on growth, not great, pretty much flat year on year, below 2% moving forwards, still a little bit below the sector, which isn't looking that great either, 2 to 3%, lower than their mid-single digit on their own 5-year average. Earnings per share also very, very poor, 3.8%, below the sector at 6 and their historical 7. Now intrinsic value $159 solely on the DCF, just below 140. Now we've used 8% moving forward. Baked in is higher at 8.5, so solely using the discounted cash flow for PepsiCo does show up as overvaluation, but using all three, you are getting an MOS on the lower side at 8. We do notice Wall Street see this roughly in line at 158. Minimal upside, the lowest one so far at 8%. If you want a 20% MOS, well, a buy at 128, which was pretty much their 52-week low. If you want it more at 25, $119. So give us your views on PepsiCo today. We then move on to General Mills, battered 32% in the last year, down 28 year to date. Over the last 10 years, actually down 21%. Not great at all. In fact, if we take a look at the price around 2018, that is probably the lowest it has been in this 10-year period, around $38. In fact, if you bought at that point, you would be up barely. If, for example, you bought the highs, we're talking nearly 3 years ago at $91, you would have seen your investment cut in half. Right now it's trading at its new 52-week low, very weak buy rating from Seeking Alpha, double hold from Wall Street and Quant, where we had a 5-year record low, at least we should say again, 12.4, below 5-year average of 16. 1 point a few years ago, it was trading at 22. Yield continues to climb higher, 5.3%, significantly above the 5-year at 3.4. But very interesting to see, no matter the disparities, still dividend safety 90, very safe. But their increase was very lackluster at 1.7, although typically nothing special around inflation at 3.7. And we can see they have been increasing dividends for only the last 5 years, but one of the best in terms of continually paying a dividend without a reduction for the last 127 years. And whilst we do get the undervaluation signal on the blue tunnel, we should let you know the trend has been decreasing. As we say, not something ideally we want for companies either we're invested in or are looking to buy. And over the last 10 years, there have been a few chances to buy this undervalue. Doesn't mean you should buy, because ultimately when it was at this level, as of today, you would be sitting on a lower share price. Just something to consider. Now valuation, first fairly positive one we've seen at a B+, 21% discount to the sector, 20% discount to their historical, but their growth, like most today, very poor at an F, negative 3% year on year, negative 2% projected, sector around the 3% level. Their own 5-year, whilst positive, still fairly poor, around the 1 to 3%, and EPS, well, that's also projected to be negative. That is negative 2% when the sector 5.6 positive, and their own historical 4.3. Now intrinsic price $59 on the average of these three does look good, but when you do in fact take a look at the DCF, it comes lower at 52. Now we have used a 2% growth rate, which you could argue is very conservative. On a reverse basis, 0.6, so perhaps just solely on the DCF, there could be an undervalued opportunity. Using all three, we're talking about a 24% margin of safety. Wall Street themselves see 54 into next year, 20% upside. Dividend also looks to be safe and very high, maybe one for consideration at 30%. Will a buy at $41, so let us know on General Mills today. We then move on to Constellation Brands, battered down 42% over the last year, 38 year to date. Over the last 10, this is flat. If you invested $10,000 10 years ago, you'd be having the same amount today, and if you adjust that for inflation, well, you would in fact be pretty disappointed. Also trading around this 52-week low where we see a traffic light system, sell from quant, buy from Wall Street, hold from Seeking Alpha. They're also trading at forward P 11.6, the lowest in fact in the last 5 years, average at 20, yield around 3%, well above the 5-year at 1.43, another double potential severe undervaluation signal, and the dividend also looks to be safe, 70 score. Now their increase was pretty poor this year at 1%, on average over the last 5 years, 6.1, and when we take a look, they've been increasing the dividends for the last 4 years, paying 1 without a reduction for the last 9. Now the blue tunnel we can see has been decreasing, undervaluation has appeared all throughout the last 12 months, and over the last 10 years, bit of a trend. Most of these companies, in fact, we don't get to see much in terms of upwards momentum. It does start to stagnate, and even during some points actually start to decrease in terms of the fair value. Now they're grading at a C on valuation, 26% discount to the sector, 39% discount to their 5-year, but probably doesn't look appealing when you do take a look at some of their metrics on growth. Revenue, in fact, negative 6% last year, negative 3% projected. Sector, again, the same as we have covered today. Their own 5-year telling us historically they grow in line with inflation. Earnings per share also projected to drop near 3% when the sector up at 6%, and their own historical looking attractive previously anyway at 8%. Now intrinsic value $178, DCF lower at 163, where we've used a 4% growth moving forward, baked in is 2.3, and as of today you're getting a 23% margin of safety. If you wanted more at 30%, well, a buy at 125, and Wall Street, well, they anticipate 170 into next year. That's 24% upside. Let us know, STZ, maybe one you're considering, maybe one you want to dump, or maybe one you do want to consider buying. We then move on to DEO, which is down 24% in the last year, down 28% year to date. Over the last 10, another one that's been down quite significantly, 17%, downward trend since December 21 at $220. Trading near 52-week low, another traffic light system, sell from quant, weak buy from Wall Street, and a hold from Seeking Alpha. Now valuation also very low, 13.3, lowest in the last 5 at least, historically at 20, yield 4.5%, well above the 5-year at 2.24. So again, the trend is pretty clear here for this industry. It has been battered. It isn't solely related to just one or two stocks in isolation, but great to see a very safe 90 score on the safety. And whilst we do have a negative here, they haven't yet had a dividend cut, not that I'm aware of, but due to FX, perhaps this is slightly skewed. Over the last 10 years, on average, sitting at 6.3%. And again, I'm not sure how accurate this data is, but let me know. I don't believe they have had a dividend cut. We can see they've been paying a dividend for the last 27 years without a reduction. And the blue tunnel also, again, pretty consistent with what we're seeing today. We're noticing the expected price, intrinsic value, fair value decreasing, and the share price consistently below the bottom end. In fact, disparity only slightly increasing over the last few months, where over the last 10 years, again, the trend is pretty consistent. Now, valuation at a C, 17% discount to the sector, 38% discount to their 5-year, and growth, you probably come to realize now this industry just isn't looking good, at least in terms of revenue. Doesn't mean it's not a buy. We can see flat year on year, expect to be flat over the next 12, but historically they were growing around the mid-single digit rate. They're projecting as well only 3% EPS below the sector and their historical at 7, and our intrinsic price 109, although we should flag DCF comes significantly below at 87, and that's using a 7% growth rate where baked in is pretty much around that 7.4, so you could argue around fair price solely on the discounted cash flow basis. But altogether, 109 is leading up to a 17% margin of safety. Wall Street themselves anticipate 110 into next year, so pretty similar in terms of that point. Upside 21% as well. If you want a 20% MOS for DEO, a buy at 87, pretty much 52-week lows, 25, 82. but give us your views on DO, buy, hold, or completely avoid. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.